Good morning, one and all. I, Priya Dugal, on behalf of Professional Development Committee of Institute of Chartered Accountants of India, welcome CA Mangesh P. Kendre, Vice Chairman PDC. Now, I would request Sir to please give his welcome remarks.
Thank you. Good evening, friends. It gives me immense pleasure to welcome you all for this series of Professional Development Committee of Unleashing and Opportunities. Today, we are here to listen and know more about professional opportunities in project financing. As you all know, the Professional Development Committee has been striving very hard to explore the professional opportunities for chartered accountants and definitely taking some steps so that our fellow chartered accountants can have different kinds of exposures and will have a varied kind of an experience in the different professional fields. Today, we are going to talk about the professional opportunities in project financing. Project financing in such a field where, apparently it seems to be very simple, but there are a number of niceties and responsibilities also there on the chartered accountants. We are having with us CA Pradeep K. Lat and CA Ankit Maheshwari as the faculties for this session today. Both of them, the formal introduction will be given by office after my introductory address. But let me tell you, both of them have been pioneers in this subject. And not only, I can say, chartered accountants in practice, but in academically also, as far as authoring the books and articles are concerned, as well as, of course, practical experience. Both are, I think, the faculties which perhaps able to guide us and give our good insight in the professional opportunities in the field of project financing. So without doing further ado, I would hand over the mic to hand over the proceedings to the Office of the Professional Development Committee to introduce the faculties and start the session. So thank you very much, all the participants, for attending this. And please give your feedbacks and suggestions to the Professional Development Committee on what you would like us to have for the programs. So thank you, Pradeep ji. Thank you, Ankit ji. Over to you, the Secretariat of PD Committee.
Thank you so much, Mangesh Kendre sir, Vice Chairman of the Professional Development Committee. You really set the tone of the day. And moving forward, sir, we'll request Mr. Pradeep Lat to start his session. So we'll just give a short introduction of sir. Yes.
Pradeep K. Lat is a member since 1988 and started his practice in the field related to the project feasibility report, financing, taxation, and audit works. His areas of competence are project appraisal and finance. Also, he has co-authored a book on project appraisal and financing with Dr. Sat P. Prashad, former director of IIM Indore. He has been the central statutory auditor of various public sector banks, and he has also been involved in other audits consulting matters for past 35 years. We welcome you, sir.
Thank you. Thank you so much. At the outset, I thank our PDC committee. I owe gratitude to you all. And thanks to you, Sia, Priya, and Khushbu, who have coordinated the event, and our Mangesh ji here, a vice chairman, and the whole team behind the whole show. I also welcome our colleague Ankit ji here, and we will put in our best possible. Let us see what we can do, deliberate. It's a huge topic. Time is less. When you came out with the talk on this, I was wondering what to talk. Just imagine, like, I am taking this subject in MBA institutes, wherein we deliver around 30 hours. But here I was to speak around less than 1 hour. So I straight come to the topic first. Okay. So let's come to the projects. What do we understand by the term projects? If you hear the word project, what comes to your mind? Is it some sort of large activity, a business enterprise, or what do they connote? Is it some huge investment or long duration activity, or where we want recurring benefits? However, in the real life scenario, in our own life, it connotes a wider meaning. It includes both quantifiable and non-quantifiable events and activities. For example, let us think of our days when we completed our CA. Doing our CA course, is it a project? A mother's upbringing her child, is it a project? Think you are choosing your spouse and getting married, is that a project? Now, each project requires variety of resources, we know that, but may not be measurable in monetary terms always. However, for the purpose of our deliberation today here, we are not to consider all those projects. We are considering projects only measurable in monetary terms. So we right away go to the project characteristics. Every activity we take up, there is some characteristic, yes or no? So any activity you take up, there is a purpose behind it. So the first characteristic becomes the purpose of the project. Why do you want to do the project? It is a one-time investment. You want to have recurring benefits. So it may deviate from your core competencies. It may within your core competencies. It can be either of the two. Now, if it is generally supposed that if it is within your core competencies, it is better. However, in the world of globalization today, we find companies, they are going beyond their competencies and anything for that matter. For example, you take Reliance, they can make for a small item from needle to big refinery in Gujarat. The next characteristic is the time frame. When we talk of time frame, it relates to the implementation schedule of the project. Now, it is a very difficult subject when I talk of implementation schedule. The question comes, when does the implementation schedule end? What happens if the project does not take off at all? In our terms, I have to define when is the implementation schedule finished. So that date of cutoff is very important. So is it the time when we start commercial production? The questions which arise. Is it the time when we have the electric connection done? Or is it the time when we have the trial production done? Or is it the time when we have the first purchase done or first sale done? There are so many questions which come to us. But I remember there was an institute publication which I read, I remember late 80s. It was on the study of the expenses during construction period. How do we treat the expenses during construction period? And I remember our institute clearly putting it up that the date of cutoff is the date when the unit is ready for commercial production. So that is the date of cutoff. So friends, so my date of cutoff is not the date of commercial production. It is the date of my unit being ready for commercial production. In the banking parlance, we call it DCCO. That is date of commencement of commercial operations. It is very important. All CS know why. Because till the date of cutoff or till the DCCO, the treatment is separate. Now, one mantra here. Generally, when we make the implementation schedule, we try and start from zero period. Like today, if I want to put up a project, the client comes to you and he tells, okay, I want to buy a land here, or he wants to take on lease. He takes off the land. He starts with the land purchase or the location. Then he goes for the project. And he goes like in the theory of present forward. Now, and he comes to the end that after trial production, he comes to the end wherein the commercial production starts. A better mantra will be think future backwards. That you lock a date in future that this is my DCCO. And from there you count backward. So that is think future backwards. With this methodology, you will try and adhere to the implementation schedule to a great extent. And it has been seen and measured that this technique does work. Another very simple mantra on DCCO is that supposing my unit is going to start in say January 24. The new unit is coming up of your client and you want that unit January 24 is my DCCO. What should we do? So you have the option of taking January 24, but to be on the better side, you can always take some gap and say you show it April 24. What happens? You get 3 months time more. There's no harm in that. If your project comes up, say within January, I don't say that you delay the project. You try to complete the project, not even January 24. You try to complete within December 23, say. So you complete the project in January 24 or December 23. You still have got time as per your bank's thing that 3 months grace is there for you. Your repayment will have start after April only. If there's moratorium, still you get more time. So there is no harm in that. Like one of our clients, we envisaged the DCCO for the bank as October. We got the production. The production was done by the client in June, and the repayment started in March. Just imagine the time frame he got during the period. And definitely, if your DCCO you can achieve in a better date, your cost of the project also comes down. You understand the interest during construction period is part of my project cost. So if my construction period comes down, definitely nothing like it. So this is one thing which I usually tell, and the bankers also tell the client sometimes. I found that you should try and check that the DCCO is such which is comfortable. So the NPA criteria also comes into picture. You know that. Now the next thing is any project you to take up, there are a lot of resources involved. So just think of a big integrated steel project, say 400 crores, 500 crores. What will happen? You need a lot of land, labor, manpower, capital to put up the project. So the resources, are scarce. And the amount of investment is too huge. So you have to use these resources very judiciously across the competing claims with proper planning. Because once you put the whole cost aspect into picture, it will be like a sunk cost. You can't come out of it. So it is a business prudence that a project should not be selected in haste. Rather, you should consider all parameters and risk factors and then only start the investment. So along with these resources, there is another factor which comes into the picture of characteristic of project. Is once I put in the investment in the project, I cannot backtrack. Something like a marriage, like if you go for a marriage, it's very difficult to get divorced. So something like a project, if you go into the project, you can't backtrack. If you backtrack, it is like a sunk cost. So if reversed, it is at a very sunk cost. You take the example of Tata's Singur project. They were about to start the production in 2 to 3 months' time. And it happened that they had to shift the whole project from Singur to Sanand. The whole transportation cost, the whole delay, the project cost got extended, the period got extended, there was a cost involved. The land is still with them. I think it is around 1,500 crores. It is still sunk cost for them till they are able to realize from the land. I remember the TISCO chairman then, he spoke in one of the MBA institutes openly that there was a bad AM for which we had to shelve the project. There was a good AM who invited for us the project and we got it going. Friends, when we are talking of the project characteristics, we are talking of the CapEx, basically capital expenditure. So you know that capital expenditure and revenue expenditure, there is a lot of difference. Any expenditure which is taxed, all revenue expenditures are tax deductible, you are aware. And capital expenditure goes to your asset building on which you can add the most claim depreciation. The difference is very clear. The capital and revenue, you know that it is like day and night. But friends, can you tell me exactly the point, the exact point wherein the day has become night or the point wherein the night has become day? The line of distinction is very thin. So we cannot tell at what point the day has become night. Similarly is the case of capital and revenue. You find umpteen number of cases wherein there is a debate whether this expenditure is capital or revenue. And you know the reason for it, why it happens. So now, why do we have to classify this? Now we have to again take some tests there. A test of efficiency, test of endurance benefits. So that another characteristic becomes is enduring benefits. Like if my project is giving me enduring benefits, if that expenditure is reducing my cost to a great extent on a long-term basis. For example, supposing I replace a part of the machine also, and the machine cost replacement itself reduces my power cost for all times to come. Definitely it is enduring benefit. Means it is a capital cost. So my test of efficiency comes into picture here, that whether that expenditure of replacement of machine has to be treated as capex or revenue expenditure. So if it is resulting in some reduction in costs, benefits, long-term benefits, or say improvement in the finished goods, say in a biscuit plant, my biscuit gets more crisp, much better with that replacement. So definitely those costs which are enduring benefits are capex and not revenue expenditure. So this test of efficiency is to be judged to understand whether the expenditure is capital or revenue. Another thing, you are aware that the project cannot be accepted in parts. It is indivisible. So either I go for the full project, I can scale down the project. The capacity can be less or more, but I cannot, do half of the project or three-fourths of the project. So I have to do the full project or I cannot do the project. So indivisibility is another criteria which calls for comparison, because we know there are scarce resources. The rationing of capital is there. I cannot choose all the projects I want. There is a need for comparison of projects. That's why. Then the projects can be dependent on each other. Now, there are a lot of examples on dependency. The dependency can be positive, can be negative. Its positive dependency means project A is helping project B positively. Project B is also helping project A positively. It is symmetric positive dependency. Sometimes the project is not helping the project positively, it is negatively. For example, tall road you make on a ferry, there is a ferry bridge or ferry already moving around near a river, and you make a tall road. So the ferry and the tall road are competing with each other. So that is negative dependency. These are some of the characteristics of the project which can be known to you. Now I come to the other part of the project, which is called project structure. Many times we have been discussing on the part that we are dealing with project financing. Now, when I talk of project financing, it means usually a very large project. It is like a, say, airport modernization, a telecommunication big project, a big Disneyland park, maybe the tunnel between England and France. It is something to do with infrastructure sometimes. So there is an SPV. You see the PPT here on the project finance structure. If it is a case of project financing, please note there has to be SPV. SPV is owned by whom? The sponsors. So the parties to the project finance structures, the owner is the SPV. The SPV is formed. The sponsor can be one, can be more. Now there is the government who is giving you the activity to be done. For example, say toll road to be done. The government is giving you the activity to be done. Now the government can also be a sponsor if it is a PPP mode. The sponsors can be one or more, as I told you. So if it is PPP mode, the government becomes one of the sponsors. The SPV is wholly responsible for the whole project. When it is SPV, long-term duration project, the debt equity ratio is more lenient. The leverage is higher. So what happens? The lenders come in. So the lenders give you more money. More money, sometimes soft loan. You take the bullet train project of Gujarat to Bombay. Japanese government, the Japanese bank has come to you, giving you softer loans, softer terms, more repayment period. And sometimes the moratorium period is also there. So the lenders are there who are lend you fund to the project and they want the money back in some time. But the repayment period itself can be quite high. Maybe 25 years, maybe up to 50 years. And there can be moratorium also. And the interest rate can be much less also. Usually, when we take up these big projects like project financing works, there is always, sometimes we find that there is always an EPC contractor. So EPC contractor is in charge of the project. So he takes up the project and maybe he's a turnkey consultant also. And he does the whole implementation of the project and he delivers to you and we get the project in time. And another aspect of this, another mantra here is, if we can get the EPC contractor as a sponsor, definitely it will help, yes or no? Because the EPC contractor may have many more projects. But supposing he is a sponsor in your project, what happens here is the EPC contractor is in a better shape because he is also getting the share of the profits of the project. So his interest in your project will be much higher than what he is doing in other projects. So this can be possible. Sometimes we also have O&M contractor, the operation and maintenance contractor, that you don't want to take the tension of the project when it is already finished. So there is O&M contractor who takes care, like we have AMCs for our small utensils or say household items. Now there is always a user, the main thing, the product, the beneficiaries of the project. Without the user, there is no viability. So for example, toll road, as a user of the road, we pick the toll. So this is where we need to have the users have to have the has to be there. So the toll road is there. Am I visible? Am I audible? Priya, am I audible?
Yes, sir, you're audible, but I think people are not able to see the screen. So if you could do it on the full screen.
Full screen.
Yes,
Okay.
sir. You can go to that slideshow option and then the full screen. So people will be able to see it.
Wait a minute. तो full screen करना है sir.
Yes, sir. So you can go to the slideshow option.
Is it okay?
No, sir. You
Now
can.
the full screen is there.
Yes, sir. Go ahead.
Okay, na?
Yes, sir.
Is it okay now?
Yes, sir.
So this is the project finance structure. Okay. What I was talking about. Now, when we talk of bigger projects, it is project financing. But when we talk of MSME projects, it is basically our corporate finance. You understand? Now, this is a corporate finance structure. Now, here you see, wait a minute. The private company is there. Say, for example, Reliance. Now, this is the company which is taking out the project. Now, again, the government is there, which is providing you the level playing field, concessions, whatever agreement. You do the investment project. The lenders are again there to fund you, and you have to service the debt obligations. And you invest in the project, and the users are there who pay for you. Now, again, small infrastructure projects can be corporate finance structures. MSME projects can be corporate finance structures. So these are the projects. The same methodology as per project finance, but the SPV is not there. The difference here, you see the SPV is missing out. The EPC contractor may be here, may not be here. Again, that can be here. Now, some slight differences, but generally large projects, we go for project finance, and the lesser projects and smaller projects, corporate finance. This is slight difference between private company undertakes this corporate finance and the project finance is a bigger companies. Am I clear? Is it okay? Next. Now there are different types of projects. I'm not deliberating on this. Now I'm coming to another aspect of projects, and we come to the roles thereafter immediately. So what happens now when I talk of the projects? We know that project. What is the project cost? We know that it is the project capex, all the capital expenditure plus margin money for working capital. But who finalized this cost? It was earlier the financial institutions in 1964 when IDBI, ICICI, IFCI, all these were the financial institutions who were funding term loan, and there were banks giving you working capital finance. So there were these financial institutions who framed the whole concept of project financing. So our project cost was defined accordingly that all the long-term funds became the project cost. That means all my capex plus margin money working capital included in my project cost. Whereas the working capital finance given by the bank was not treated as the project cost. So basically the long-term funds became a project cost. My project IRR on the basis of the long-term funds cost, and my total funds was not into picture. Now my question is whether we should, today the scenario is changed. IDBI is changed to bank, ICC converted to bank. So now the banks are giving you term loan and working capital. Now this has started off in 80s itself and more in 90s. The banks are giving you both long-term and short-term. So what should we do about that? My question is whether we should still go ahead with the same definition or it needs a relook. The IRR of the project is what the bankers want, project IRR. The IRR of total funds is not used by the banks. So whether we need to have a relook to that or not. Is that clear? So my question still remains, now when a promoter comes to you, he needs the IRR as per equity. So we need to find out the IRR as per equity, yes or no? So what happens now is that equity IRR is important from the promoter's perspective. The long-term funds IRR is required as per the bank's perspective to lending, as per the project IRR. Further, the total funds perspective when the bank is funding you both, this is not taken into account as on date, whether we should relook this into or not. Am I clear? So this is where the question arises that as a consultant, when we go, we talk about the projects. When the client comes to us, we tell him that okay, this is your project. So we calculate the gross profit ratio. We go with the thumb rule approach, and then come back and then try and tell him that this is your payback period. This is how you can go about, and like that we go ahead with the whole thing. So what happens basically is we give the client the idea how to go about. So project IRR is important as per bank. The equity IRR is important as per the client. So we need to know both. So as a CA, we have 3 sets of cash flows: equity flows, long-term funds flow, total funds flow. All 3 IRRs, 3 NPVs. So as a CA, we should know all this. This is my contention that our knowledge base should be strong. Now I come to the awaited topic of our role of CAs. So our role of CAs, you see, our CAs, with the qualification we have, we definitely possess the sound financial, the knowledge is found there. We have got a base, we know about the finances very well. Our basics of accounting, finance is very good. So we possess a good knowledge on this. We can thus act as a valuable coordinator between the bank and the entrepreneur. This is very important for us. We can understand the bank's perspective very fast. And we can easily prepare, like you know that preparation of the CMA data or the projections is very easily can be done by us. But the client is not very equipped. Maybe he's a in-house chartered accountant, then it's okay. Otherwise, he outsources to other CAs or other consultants. So this is area which we are required to be done. And the CAs may also help in compliances sometimes. And we can understand the banking parameters, the ratios, the financials. We know the bank's norms. So we can understand the bank's things, and we can be a good connect between the entrepreneur and the bank. That is definitely there. Now, with this in mind, you can understand that this is definitely a big area. Now, what sort of activities can be done by us? Now, the first is the Greenfield project, which is very common that any new project will come up. A new project which will come up. So we will generally, when I take up a project, I tell that we should visit the site to know first-hand information. If you can visit similar projects, nothing like it. Today, you can see on online mode also. So if you can visit similar projects, you get the first-hand information, the preparation of the project can be better. Now, projections, you try to make it conservative as far as possible. Other area can be expansion of the project, diversification by the company, means there is an existing balance sheet. If there is an existing balance sheet already there, that means your complications are there. That means I have got a starting point in my balance sheet. My starting point, and then my addition or diversification, and then again a total column. And my depreciation again will change. You should understand, supposing all my implementation period is more than 1 year. So during that interim period, my depreciation, scheduling, and all those, you can understand, visualize, my complications will arise. Another area which is restructuring. Like the unit is not doing well. So you have to come back with the restructuring proposal, and you tell the banker that, okay, I want more time, a reschedulement of the term loan, some incentives available, reduction in rate of interest. So many things you can take benefits. And then again, here also, there is the existing balance sheet. The model is definitely going to be more complicated than a greenfield project. So we should understand that restructuring can also be an area. The simplest thing is the renewal of limits. with or without enhancements. Now, this renewal of limits is a regular work, regular feature, like we do for auditing or taxation for the clients. Like renewal of limits is very common. Now, this is more so in the case of public sector banks, and not as much for the private sector. Now, this remember that renewal of limits, usually the private sector do it on their own. So, if it's a public sector bank, they ask the CS to help them out. Now, it can be possible today that you can take over of the limits to some other banks. Now, supposing the limits are there already with some bank A, and the takeover is taken to bank B, which results in some benefits to the client. Definitely, the client gets some value, he will appreciate. With the same bank also, if you are able to reduce the cost, for example, recently we saw a client paying huge bank guarantee commission charges with his prime bank. I found that he was paying something like, he was getting discount, but the discount after the discounted rate was quite high, and was 1% higher than what we could get for him from other banks. So definitely, if you can get such reduction in ROIs or charges by BG commissions, etc., that can be a good area for your project financing area work. Now, everything doesn't come very simple. We have to have some caution, care. You cannot certify the projections. Our institute does not allow us, and it is right that we should not certify the projections. Something in the future, what is going to happen is not our baby, it is the promoter's baby. We are trying to help the promoter, but we are not to certify the papers what is to be submitted to the bank. We should have thorough understanding of the project before we go on to the project preparation, etc. Now, the first meeting with the lender is very important, because you as a CA consultant with the promoter should be thorough with the financials of the project. The promoter should be ready with the technicals, the project cost, the basic data, the ratios, the important financials. All this should be in your mind clearly, because the important part is the first meeting, is the first impression you get. So it is very important, and that is the area of financials is our area of focus. That you must not skip in any case. Now, your understanding of the project in a wider area is also required. The vision, the value being added, the competition, etc., to be known. Now, as we know that the financial, our area is limited to financials, so we should be able to understand the financial analysis of the whole thing, and we should also have a thorough knowledge of the lending policies of the banks who are doing these things. Now, every bank has got a certain lending policy. Now, they have got some emphasis area, some areas where they restrict. So, you should know that this real estate project or say a steel project will not be financed such and such bank. So, you have to go to the lending policies, or you must be able to get the understanding of that, and then you will be able to understand and get to have more knowledge. Further handholding may be required even after the sanction of the project. Sometimes it is so that the project is sanctioned and there are some terms and conditions to be met, and you have to help the promoters how to go about. Sometimes the promoters are not aware about moratorium period. Sometimes the promoters are new, they don't know about the DP, the drawing power criteria. So you might have to educate them. Submission of stock statements. So those and part and parcel of your work, that you might also need to educate them how to submit documents to the bank, how to handhold them. So this is a very important part which comes along with your project financing. Now, sometimes we get terms and conditions which are not in the ethos which was really discussed and agreed upon. So if there is some amendment to be done later on, you have to get it done, because supposing you had agreed for bank guarantee commission of 0.75% and the bank charged you 1%, 0.25% more, and you want it to be 0.75%, and you go for amendment. Now, that has to be taken care of again, it may take some time. In one case, we noticed that the client told us that the bank has debited some amendment charges. Now, is it ethical? Since you had gone to the bank that he will be charging you this much commission, and he charged you more, and then he makes the amendment and charges some amendment charges, which is not ethical. So it should be reversed. So that is what I told the client, that you go tell him that it should be reversed. But that is not the purpose on which we were trying to do. This are the some care, the help you need to do. It's not an easy job, but definitely it needs a lot of work there. Now the benefit. What the benefits are there? Now our HCAs, as partners in nation building, we have got many owners. Our life is on deadlines. We know that we have got GST dates, we got advanced tax dates, we got income tax filing dates, we got audit dates. So whole life is fixed on deadlines. We can't have the deadlines, we can't escape. And God forbid, if you have some medical problem during those dates, it's very difficult to manage. Now this is one area where there is no timeline or deadline. So this is the best part of project financing, that we don't have timeline or deadline. You can do as per your own sweet will. If you cannot have time, do not have time, you can decline the work and do it later on, or maybe that you forgo the work. It is no certification. Like in the audit certificate, we certify, whereas here there is no certification required. So the onus is of the borrower. But certainly it doesn't mean that certification is not there. It doesn't mean that we are escaping our responsibility. The banker knows that you are behind the person. So our check of the project and the promoter should be beforehand, that we take care of the integrity of the person, the project flows, cash flows, repayment capacity, all those things in detail, so that the promoter does not default in future, the project runs smoothly, and we are able to repay and the promoter is able to repay the whole project in time. So you get, once you do all these things, you get value for your time spent. When you do audit work or some attestation work, which is mandatory by the government, the client does not see any value on that. The client says, "Yeah, it is my mera to karna hai, mujhe ye to majburi hai." So he doesn't see value. He doesn't try to pay more. Whereas here, if you try to save some costs, say you save interest 1% for him on 100 crores, you're saving 1 crore. So immediately he sees a value that you have saved for him 1 crore. So immediately that will give you that, okay, here this CA saved me 1 crore. Or you save him 25 lakhs by 25%, say 25 basis point reduction in the ROI. So that makes some value addition. So you get value for your time spent, value for your knowledge, value for your efforts. This is where the project financing is a lucrative area, and you can do vendors. And another thing is that you get money for him. So once you get money for him, he's ready to pay, he understands that there is value for that, because he understands he's getting money because not only on his efforts, because of my CA also. So you see, you don't have to certify. There's no timeline, deadline, and you get rather still more money than what we do in audit. But again, it has to be with knowledge and expertise. As a CA, I don't advise students or the new CAs also not to be in too much of hurry to get the knowledge. You should go theoretically very sound. You should attend the workshops by our institute. Our institute was contemplating on a certificate course on project financing, and we had suggested some curriculum also on that. If that comes through, definitely it will be a sort of theory and practice there, that when we have case studies, and then we can mix of theory and practice, and then you learn about that. And we have sometimes these workshops also online, offline. So this can help you out. The CA students in the GMCS course also have this subject of project financing, but to a lesser extent, which is much less. But then we should have to gain knowledge. This is must. So how to get knowledge is a very difficult scenario. It is not a one-day job. It is definitely a time-consuming job. But this is where we need to have a lot of preparation. When we started off project financing work, you remember there was no Excel. We had to do it manually. And just imagine that I have to do around the whole calculation 4 to 5 hours. Then I have to, if my DSCR is not, say, correct, is not within the bank's norm, say it is, my bank's norm is say 1.6, 1.7, my DSCR comes to 1.3, 1.2. So I am again in doldrums. What option do I have? Again, I have to repay. Again, I have to recast the whole thing. I might have to increase the period of repayment. I mean, the extension of the loan. So instead of 5 years repayment, I may make it 7 years to get the whole thing. But with the expertise, I knew that, okay, I can get it done. Today, at the click of the mouse, you can add 1 more year, 2 more years, and do it very fast. But still then we make errors. Because when you do copy paste, it needs some bit of knowledge there. So we should not do only copy paste. The concept should be very clear. And then we go about the knowledge. This is very important. Definitely it is a lucrative area, but then it comes with a lot of caution. So I'm now limiting, this is the role of CAs, how we can benefit. I'm going to the stages of project development. The time is not very much. What I'll do is, I'll just go to the stages of project development, discuss about that, and end very soon so that the other speaker comes up and we have time on the question answer also. Because this is a very huge subject. It's not possible to be finished in a small time. Now, in the stages of the project, we have idea generation, which is the conception stage. The second stage is the pre-feasibility stage, and the third stage is the detailed feasibility. In the conception stage, the first and foremost important thing is the source of idea. Now, how do the ideas come to you? Now, if there is some missing attribute in the market, this can certainly be a good area of project. I'm reminded of my MBA days when we were doing an XLRI. That time we had detergent of Hindustan Lever, that surf. No lady would tell her servant to buy detergent from the market. She will tell the servant to buy surf. Like we had Xerox instead of photostat. So there was, detergent was known as surf. When Nirma came in, and they came in with 2 attributes. One was whiteness. That the girl was going round, and the skirt was getting white. And another thing was the pricing criteria. So they came out with a low price detergent, and they emphasized, the public got the idea that there is whiteness in the project. The product getting whiteness and the low price, Hindustan Lever got a big jolt. From 20% of the market share went away, and it could not retrieve the market share in any case. So this was a big jolt for the market. Later on, Nirma's share has gone to some extent to Ghadi detergent today. But then Hindustan Lever, Unilever today, got the lesson there, and they tried to be proactive. In Brazil, they tried and they brought out their own, low price detergent on their own before they could get some competition. So the ideas can come from anywhere. There are a lot of areas. I'm not deliberating on that part. So the ideas can come from many areas. Just a description. The ideas can also come from your dreams and a lot of brainstorming sessions. Like we say, Vivekananda used to deliver his sermon next day, hearing his guru's, Ramakrishna Ji's dream. And his dream, Ramakrishna used to appear. And next day he used to deliver his sermon extempore. That is another way that it comes to him automatically. Similarly, Archimedes, that principle of displacement, he was in a pensive mood in the bathroom and he found the theory of displacement. So there are many such theories. When people see in their dreams, the molecular theory by Benazine, he saw in his dream the serpent biting its own tail. So he got that idea of the round molecular structure being round. So these are the areas where we can get the ideas. Then the next stage is pre-feasibility study. When we are not able to do the detailed feasibility study, because we have n number of projects, we have to crystallize some of them. We go to the pre-feasibility study, try to see what are the factors there, and try to understand each parameters there, like input, output, and then rate the whole thing, get to a minimum rating percentage. That, okay, I cannot get 100% rating for any project. But when I choose a project, I am biased. So I try to remove the bias by rating the project. So I do a project rating index. You can see from the slide. Different criteria are rated out. And we get a score, say 75% is my cutoff date. So this becomes my acceptability position. Like we have credit risk rating for the bank when we do the appraisal part. The bank has got credit risk rating done. So they have got some benchmark levels on which after below which they will not fund, beyond which they will fund, and what rate, pricing, all those things. So something like that. Project rating index is required in the case of this. Now I'm coming straight to in the criteria of when we choose a project, there are 5 C's which are very important. One is character, the integrity of the promoter, his management capacity, all those things. His track record, the payment record, that he is doing regularly payment, his track record is good. The capability of the project, either the project is able to service the debt obligations, for example, the debt service coverage ratio. So that is a very important part, that the project will be able to service the debt obligations. Another part is the capital, basically the overall strength of the promoters to bring in capital if required. If the project has got some cost escalation, whether the promoters will be able to bring in more capital, whether they can sustain the cost escalation, all those things. Collateral, today we know that every project, any debt funding we take is collateral based. So that loan to value ratio, fixed asset coverage ratio comes into picture. So any funding for that matter, unless you have the primary security too high of value, then the conditions of the market, how it is prevailing, volatile or stable, the technological risks, the obsolescence risk, the economic cycle, what is there, political risks, a lot of things which comes into play. These are the 5 due diligence, 5 C's, which we call a very important part of my choosing a project. And then we go for detailed feasibility studies, the marketing, the technical, the financial, and also the social cost benefit analysis. You do the credit risk rating. This is just an indication of my components of the cost of the project. We, as a chartered accountant, we need to crystallize each and every item. We basically get the data from the client, we get the information, we try to get the information, and then go on for the formulation of the project. This is the start point maybe. And the other part is the proposed sources of funds. Now this is where we know that there are 2 basic sources of funds, equity and debt. Now debt, we know, is more cheaper than equity, but we can't get 100% debt finance. There are constraints in real life. For example, debt equity ratio, the margin requirements, the DSCR. Now, if I want to buy a car also, the bank will not give me 100%. Supposing I want to buy a car of 20 lakhs, will the bank fund me 20 lakhs? No. They will ask me to bring my margin. Similarly, when I invest in a project, the bank asks me to bring some margin. So that is the margin requirement. Now, each industry has got some leverage ratio. It can be 1.5:1, 2:1, 1:1, depending on their lending policies. So we need to know what is the leverage ratio. So debt equity ratio, further TOL by TNW, which we call as gross debt equity ratio. But TOL by TNW also important because every project may have some current liabilities. So my debt equity ratio as well as TOL by TNW, both ratios are important. And further, the DSCR, the debt service coverage ratio, the ability of the project to service the debt obligations. Now, these are some constraints which are limiting my debt component of the project. Now, then we go for financial projections, each and every item. We go for project components of the project, sources of funds, the operating statements. Maybe that when we have time, we can talk about this later on. And I want to finish it up now and try to, then we go for this detailed, maybe that you go for detailed appraisal, technical appraisal, the marketing appraisal part. In the marketing, we see the demand supply gap is there or not, for example. The financial due diligence, which we are supposed to do in better way. And this is where our focus area should be definitely there. And this is what is required by us. So this should be done very properly. So, and we should have all the ratios well connected, the projections well done, have the conservative picture there. That is better always. And I want to end with this quote of Swami Vivekananda, that you should take up one idea at a time, make that one idea your life, think of it, dream of it, live on that idea. Let the brain, muscles, nerves, every part of your body be full of that idea and just leave every idea alone. This is the way to success. So thank you, friends. Thank you, all my colleagues and all those who have heard me for the patient time. And this is where I close. For the time being, I will leave the house open for the next speaker, our colleague, Mr. Ankit. Thank you so much.
Thank you so much, sir. It was indeed a very informative session. Thank you so much from all of us, and I hope the members were able to understand about the project financing and its complexities as well. So now I would request the Ankit Maheshwari, sir.
Hi, Priya. It was very wonderful to hear Pradeep Latsa, and I think you made a wonderful deliberation. You may please continue. I'll start then.
So, CA Ankit Maheshwari is a chartered accountant with an exceptional track record of over 15 years of professional experience. He has been instrumental in driving initiatives that promote ethical standards and professional excellence within the finance and accounting industry. Sir's dedication to monitoring and guiding young professionals has made him a valuable asset to the industry. His contribution to the field of finance and accounting have also been recognized through his research publication and articles on tax literacy, accounting, and finance. His research has been published in leading journals and has helped him shape the discourse on these topics in India. Today's topic for CA Ankit Maheshwari would be insights into unrated universe of project financing, and also the explanation by examples and also case studies. We welcome you, sir.
Thank you, Priya. Thank you for this initiative. And it's always, good to be part of Institute's initiative. I would, congratulate PDC Chairman, Vice Chairman, your team, to come up with such a great session which talks about unrated project finance, right? And it's a great area to talk about. But my full compliments and to our previous speaker, CA Pradeep Latji, who very well deliberated on the overview of project finance. As you told, we will come up with some examples. I think one case study would be enough for next 40-45 minutes to dissect the entire unrated market, unrated project finance market. So I'll just start sharing my screen, and as we are time constrained, we'll be more crisp. Also, I want, if any questions come in between, I'm happy to take these questions. Idea is that let's make it very interactive with these virtual webinars. Sometimes the participants are not interactive enough. I have a very humble request. We are discussing and deliberating on a very interesting issue. And I have come up with a case study of Adani Green. And I hope, it solves some purpose, and let's try to be more practical. Also, the idea will be, as rightly said by Vice Chairman, my idea out of that entire case study is where do we see ourselves as chartered accountants? So let's try to unleash some roles. Let's try to figure out what are the new trends. And maybe, I'll also try to make it as fruitful as possible for you people. So immediately I share my screen. Is it visible?
Yes, sir.
Okay. So let's quickly, go into the backdrop of it. And while I was in 2021, right, I read this headline and I captured it, that project finance on its last legs in India. This lines comes from a very renowned newspaper. My question to you is why such kind of a scenario? And I would appreciate the last speaker, the way he distinguished between project finance and corporate finance. I think that is where I would also want to take you. But this headline itself indicates one thing, that there has been a paradigm shift in last, I would say 8, 9, 10 years with respect to project finance. So when we conventionally look at project finance, let's go back 20, 25 years and let's try to dissect what has changed and how do we evolve out of that change. So when we go back 20, 25 years, there used to be limited financial institutions, coming as an option to take funds. I would say I come from Rajasthan, and Rajasthan had two premium financial organizations. One was RICO, Rajasthan State Industrial Development and Investment Corporation. And then we had RFC. So all these state government came up with their own financial corporations to support these industrial projects. So this was a scenario, say 20, 30 years back. And then the bankers came up, and bankers which were initially financial institutions like IDBI or ICICI, then came up and started doing more aggressive about project finance. So India took a leap in terms of market of project finance in, say, between 2000 to 2010, wherein I would say maximum projects were sanctioned, and there was a lot where lot was done in respect of project finance. So this was the era, and then came an era where we started feeling that project finance doesn't hold that kind of a grip. And I would say why? Because the answer has been given by the last speaker himself, because he told how he defined projects. The definition of projects has changed, and that is why these conventional banks started this entire headline came out of, because ICICI had their own project finance division and they shut down that division in 2019. And similarly, if I talk in context of state government's financial institution, so RICO, instead of financing projects or providing supports to the projects, started dealing with industrial land, and they had more fun doing that. This year, RICO registered a profit, say, of around 1,100-1,200 crore, a state industrial financial institution, by selling land. Whereas while they were doing project financing, they had this problem of NPAs or losses which arise because of heavily funding these projects. And the same story lies with the bank also, where bank took a lot of exposure with large industrial projects, and unfortunately, India has seen a lot of NPAs in last, I would say, a few years, which makes this story. So the idea is that the projects have changed, and I will not take much time because I think Lat Saab has given a good overview of project finance. But let's go back to basics. The convention was that it is a method which was used to fund large-scale industrial and infrastructural development projects. As I told you, India has seen a great growth. And today, when we talk in terms of corporate finance, project finance, then there are certain sectors like energy, like infrastructure, like transportation, telecommunication. These are those thrust sectors in which, a lot of capital is required. And the concept of entire, conventionally funding a project, it has shifted. It shifted from a conventional, debt equity, where a promoter used to say give 30% of his own equity, 70% was done through debts, moved to a scenario wherein government started coming up with concepts of BOT models, build, operate, transfer. And then again moving to, now the new model is build, operate, finance and transfer. So these public-private partnerships, these things are the new things which Lat Saab also addressed. And when you desire to practice in this area, then I think it is important that we understand what are the latest changes. So I would say, let's, first come on, understand what is unrated universe in project finance. And as the name suggests, right, it suggests that unrated project refers to projects which are, which have not been able to obtain credit ratings. Now, if anybody can answer me this question, why would a project will not get credit rating? What are top 5 answers for it? And Priya, I request you, if you can, give me those answers so that we try to make it more interactive.
Definitely.
Why would in India projects will not be given credit rating? Which kind of projects PDC wants to talk here? Which kind of projects I want to discuss with you? Let's try to dissect these projects when we talk about unrated universe. Where do we face these kind of projects? Where do we find these kind of projects? I'm looking for some answers in case anybody from the participants can tell me what do they understand by unrated projects? One, as I told you, there are those projects in which credit rating is not done. Two, I would want to also know what are the sectors you think are belong to the unrated sector. Priya, we have any answer?
No answer yet, sir.
How many participants we have?
Sir, around 2000.
My God. And I think everybody is on, I think, mute and the screens are off, right? So my request would be, let's try to, dissect these sectors when we go ahead with the slide. But as I told you, still RBI never mandated about taking credit ratings before they fund a project. Still, there are certain sectors in which banks want कि credit rating को देना चाहिए. So one thing is for sure that unrated projects exist. Which kind of sectors they are, we will discuss. The other thing is, while they are unrated, so it becomes for a lender, it becomes difficult for a lender to eventually do the risk management exercise or do the appraisal which the previous speaker was talking about, and come to a logical conclusion whether they need to support this project or not. A rating gives a lot of credibility. And in this case, when a project is unrated, then definitely the only way to see through such projects is to provide additional information, do extensive due
So we
diligence.
have got few answers. Somebody has said greenfields projects, and someone has said rice mill industry. The third option is power infrastructure, water, dams, railways.
Fantastic. I think we've got very relevant answers because these are those sectors which we will be discussing. But yes, all the three answers are absolutely correct answers, right answers. We will come on the sector thrust, but these answers are correct. Importantly, what I was trying to communicate here is that while a project is unrated, it is important that, as chartered accountants, we see a lot of opportunities in unrated project. I'll tell you why. Because if we look at conventional projects where credit ratings are done, you look at conventional businesses where already, bankers are very aggressive in funding these ventures. So if I am a Reliance or if I am a Tata or a Birla, the bankers are clear enough to, fund their projects because they're well-established brands of the country. They have, clear vision, mission plans. Their plans are executed. Historically, they have been able to do very well. And they have their credit rating agencies backing up their financial, backing up with whatever they are saying, right? The problem comes where we don't have structured businesses. The problem comes where, as rightly said by one of the participants, we have greenfield projects. There is no historic data. There is no, previous precedent. Now, in such a case, that is why I said a chartered accountant will have a vital role to play into this, because I feel that all these business have enough access to money, enough access to banks. A role of chartered accountant is critical when he needs access to these banks or financial institutions. When you find an entrepreneur who requires an access to banking and finance, then only he will desire a chartered accountant. Otherwise, today's banks are so aggressive that they are automatically, they are themselves moving to, the entrepreneurs directly. As far as the other work is there, the project reports, the feasibility reports, your, financial models, everything now is done through great softwares which we have today. So our role has to be an extensive role, and you will find your role where you find such kind of projects. One. Second, to see these projects through, it is important that an extensive due diligence exercise is done. How do you build the trust of investors or lenders? Now the role of chartered accountant becomes vital, right? As to how does he present a project, how convincingly he's interacting with the bankers, what all what all, financial apprehensions the bankers have as a professional, how do you justify them? There, I think we have to play a significant role, and that is why we came up with this session of unrated universe. So naturally, where there is an absence of credit rating, right? The problem lies there. Uh, as CS, as I told you, the fourth point that you have to showcase strong project fundamentals, robust financial projections, how effectively you are mitigating the risk on behalf of your client, what are your risk management procedures, and that is what we will be discussing, henceforth. So this was the question, and absolutely right. We had some answer there. The greenfield infrastructure projects are projects where you see credit ratings are not done. Another is the startups, and as we come in a situation where India is the number 2 country in terms of the new ventures, the startups. We have seen that last 10-15 years it was all about private equity, it was about angel funds, it was about venture capitalism. When now today I see, yesterday only I was having a discussion with a startup CFO who comes from Bombay Shaving Company that they were sourcing private equity since last 7-8 years. Now they have bankers. So these startups have also understood the fact that it is not only the equity support which they require, but it is also the debt support which they will require. So out of all these sectors, I think the startups, the greenfield and the renewable energy projects are those projects which we should try and focus more on. So that should be one idea. The other industries or sectors which I feel is the real estate sector and micro and small and medium enterprises. Now the problem with unrated is that India has got a bad history when it comes about unrated financing, as I was previously also telling you. And that is why banks have become very conservative when they look at the performances of JP, or they look at the performance of BPTP, even to an extent, all these Amrapali in Delhi NCR, all these companies which were conventionally into real estate, right? Bank had a lot of exposure and had a lot of tough time, and that is why they became conservative into it. And that is where I feel as a professional we have to really crack this and try to convince the lenders to support such projects also, which are important. The other projects are the renewable energy project. Again, I would say the history has been bad. While government, when came up with renewable projects, say last 10 years back or 15 years back, there were a lot of power purchase agreements entered by state discom at very hefty prices. Eventually, state governments were not able to fulfill the commission. The initial rate in Rajasthan to procure a solar power was 15 rupees, 15 or 16 rupees per unit, which came down to say 2 rupees, 2 rupees 10 paisa in last year, which itself indicates that this market has seen a lot of competition. Now the problem with credit rating agencies or bankers supporting these projects is that they don't find that visibility of even realizing that 2 or 2.5 rupee because of the fact that discoms of this country itself are very stressed. Similarly, I would say that also they were not sure about how the technology would go. Similarly, the greenfield infrastructure projects, they also they are complex projects, and as I was telling in the beginning of the session only, they are more focused on how the vendor builds it, operates it, get it financed, and then transfer it. So the entire process for a credit rating agency becomes very difficult. So all these 4-5 sectors are the sectors. I see potential in all these sectors. I see potential that as chartered accountants, we can play a vital role. I will dissect the role with the case study itself. But I hope till now, whatever point I am trying to make out of unrated projects, I hope I am able to clear them. If there are any questions, you are please free to ask those questions. So why I was, while we started with the session, we were coming on the point that why unrated projects itself. So as I told you, the number one reason is that we have limited historical data, and that is where a project remains to be unrated. The other is sector specific challenges. As I told you, the real sector has its own challenge. Sometimes even the power sector has faced a lot of challenge. So there are a lot of scars in last 15, 20 years in these sectors, where and then there could be a case that there is a project specific risk where a credit rating agency is not able to help an enterprise. Sometimes enterprise voluntarily chooses not to take that credit rating if it is an unlisted entity, and sometimes it is the investors' preference that they don't want a credit rating. They do their due diligence, or they deep dive into a particular venture before investing into it, or before providing any lending support to it. So all these data, because of all this, you find this entire universe of unrated projects. I'll straight away want to come up with the case study of Adani Green Energy Limited, because it itself is a good debt arrangement, which Adani was able to source for a greenfield project in Rajasthan, a hybrid project. And I want to deliberate on this case study. One, also with this case study, I want to deliberate on what new roles we should see in. So let's try to understand this entire case study. So Adani Greenfield secured a $1.35 billion debt facility, right, for a renewable portfolio which comprised of solar and wind project. Let us understand what happened here. This facility eventually was availed through involving 12 international banks. So when we are talking in today's era, and we are talking in the larger projects, an international funding or international banking is also important. Sourcing the funds from international banks is also very critical. The facility will initially finance 1.69 gigawatt hybrid portfolio. So hybrid is where you have projects of both solar and wind together, right? The same was done through 4 special purpose vehicles which were formed in Rajasthan. As the previous speaker told the relevance of a special purpose vehicle. So today you will see that once a special purpose vehicle is formed, there is no credit rating kind of a thing. The credit ratings are generally done for the companies, right? The greatest feature is it was the largest project financing deal in renewable sector. Also, it was the first certified green hybrid loan in India. So that makes it itself unique. Now, I hope from transaction point of view, what has happened or what is the background of the story, you are able to understand. That now we'll look in the modus operandi, and we will look into what kind of role as chartered accountants, as financial consultants, we can assume in such kind of a unconventional way of funding, or a funding of a unrated project with that kind of volume, seeking international support into renewable energy. So it had all those unique features, and that is why I am coming up with a case study on same. So this project, I also want to bring few important things, and this has some relationship, right? This project had some legal counsel, right? Now, I hope you read one thing, right? There are 3-4 opportunities which are coming out of it. Definitely, chartered accountants who are legal counsel also naturally can be legal counsels to such project, and you always have 2 counsels on the buyer side as well as on the seller side. But I see a very important terminology here, which says financial model audit consultant. So that is one role I feel that we can assume, and what do we do in that kind of a role is what I am trying to highlight out of this session. The second is an independent assurance provider. So irrespective, Adani Green might have their statutory auditors, but they have an independent assurance provider. Now, who do we provide this assurance? We will definitely discuss. Also, there are certain there are certain environmental and social consultants. So those who are dealing with ESGs, those who are dealing with sustainability, right? They would understand that the new projects requires environmental and social consultants and want them to do impact assessment. So primarily, I see 3 or 4 opportunities, right? One, there environmental and social due diligence. Two, a legal counsel. From chartered accountant specific point of view, I see the financial model audit consultant as well as the independent assurance provider could be someone, some new roles which we can assume. So let's try to, find answers to this. Who is a financial model audit consultant and what is his scope of work? So assuming that, if you are a strategic advisor, if you are a chartered accountant, if you are advising your client for that kind of a deal, then as a financial model audit consultant, what shall be your scope of work? Priya, I'll again request you to please, look for answers. We are deliberating on a very important scope of work, which is the financial model audit consultant. And I want to know from the participants, what do you think is the role of financial model audit consultant? As of now, we talk about preparation of financial models, preparation of investor decks, communicating with the banks, talking to banks, convincing them. All these were conventional roles, as I told you in the beginning of the session only, that the conventional roles have been now changed to the newer ones, and I come up with a new role, a new service portfolio for we chartered accountants, the financial model audit consultant. So, Priya, do we have any answers? What could be a probable scope of work in this kind of a deal of a financial model audit consultant?
Not as of now.
I think there's a lag between the session also. Generally, when I deliberate, I realize that there's a lag of 20-25 seconds.
Okay, I don't feel so. Let me just check again. But
Okay.
I have not received.
So I'll start dissecting. If you are looking for a new domain, I'll start dissecting what does a financial model audit consultant do in that kind of a transaction. So his first job is to vet the integrity of model. As the name suggests, name is itself suggesting that whatever financial model this company has come up with, they need an audit of this model. Now, who needs it? So is it the lender? Is it the stakeholder? Is it the bankers or your investment partners? So all those who are stakeholders to this in this entire deal, even the partners to the deal, be the legal partners, be the ESG partners, be the other partners, they also require it. All the banks, as I told you that this fund was secured through 12 international banks, would also require that. Also, this is not only a practice which is followed in case of while you are sourcing funds internationally. This is a practice which you even on the larger projects, even the Indian banks also have started coming up that whatever financial model has been prepared, we want audit of this model. Now, what we do here is the first scope as chartered accountant, which you have to do is that you have to vet the integrity of the model. So when we say integrity, it itself indicates that it means that it has to be free from any errors. It has to be free from any logical inconsistencies, right? As chartered accountant, you need to examine the model structure, the formulas, the calculation, and need to vet and give it to the lenders and certify to your report will certify to the vendors that this model has enough integrity. It is free from any logical inconsistencies, and the formulas and calculations are also free. And that is how the drafting of this report shall also be. The second, as financial model audit consultant, which we need to do is check the accuracy of data. When I say accuracy of data, so this financial model audit consultant will check the source of the data, validate that whatever source or inputs which have been considered for in this financial model are correct, and he will give a certification on it that whatever source is taken is correct. The third validation is the formula and calculation validation. And if there is any potential errors, he will highlight these potential errors as a part of his report, which may impact the results. The next is the assumption validation, and whatever assumptions you take while you are preparing a financial model, they needs to be documented. These assumptions needs to be documented, as well as the assumptions will be validated by somebody who has enough exposure of the industry and have enough research on that kind of assumption, on that kind of business scenarios. The next is the model documentation itself, and he will see that whatever financial model this company has prepared is backed by adequate documentation. The methodology of preparing the financial model, the scenario analysis, the references, the formulas, everything needs to be in terms of data. What kind of data this company has kept to make this financial model? This data shall also be audited as a part of financial model audit. The next three important things. One is the sensitivity and scenario testing. And as the name suggests, how do we do sensitivity and scenario testing? We shall discuss it later, or maybe on the next slide itself. And maybe, considering the case of Adani Green Energy, I might expect some more answers from audience with respect to sensitivity and scenario testing. Also, naturally, whatever reports this consultant prepare, these reports are the comprehensive reports based on recommendations. These recommendation moves to the company. In turn, it moves to the lenders. The point is, who appoints this financial model audit consultant? So is it the company who appoints it? Is it the company who is procuring funds will appoint this financial model audit consultant? Or will it be the lenders or other stakeholders? So the answer to this is either of us can appoint it. But in Adani's case, it was appointed by the lenders themselves. And the fee also was borne by the consortium of the lenders in this particular scenario. The next is the risk assessment exercise. And how does a model, it is the ability to incorporate risk, perform risk analysis. How do we do that? I think the rest points are report-based points when you talk about model integrity or data accuracy or assumption validation or calculation, or even the documentation. I would want to detail out two important points. One, the scenario and sensitivity testing, and other is the risk assessment, that if we have to do a scenario and sensitivity testing in this model, how do we do it? And if we have to do a risk assessment as a part of financial model audit, how do we do it? So my first question is, if this is the transaction, I go back to the transaction. If this is the transaction, then how do you do sensitivity and scenario analysis? So with scenario, I think it is very clear that while we were talking about scenario, we talk about the optimum scenario, a worst scenario, or a best possible scenario. That analysis conventionally also we were doing in financial model. But my point is, how do we do a sensitivity analysis for a renewable energy project? And what all factors, what shall be your KPAs, what shall be your KIAs, what all numbers you will start doing this sensitivity on? Can anybody come up with an answer? There I'm expecting an answer. So we are trying to do a hands-on sensitivity analysis of this entire project.
Yes, sir.
we are trying to do a sensitivity analysis of this project. If say we are the consultants to it, how do we carry this sensitivity analysis? And I'm expecting some answers. I'm expecting the variables on which we as chartered accountants should do sensitivity analysis. Priya.
Right, sir. I am actually looking, but there are no answers as of now.
Did we got the answers to the previous question?
Yes, I think few. Just let me see. And we've got many other questions too, but one of the person has replied that projections will be certified and the vetting of the financial model.
Correct. So you can name the participants also. So maybe
If
they
the projection
also
will
have
be
some.
certified is given by Mahesh Shah,
Okay.
and the vetting of the financial model is given by Rajiv Ranjan.
Perfect. So I think that is what a financial model audit was. And now my question here is that if we have to do sensitivity analysis, then what shall be the variables you will consider in a financial model, and how do we do that? So if we have any answers to this, on what all variables we will try to do that. And then we do a similar exercise for risk management.
I'm waiting for some answers to come.
Okay. I think we'll wait for another 20-30 seconds, else I start deliberating.
Right, sir.
In meantime, you can take up those questions. Pradeep sir is also here if he wants to revert. Uh, by the time we go on the sensitivity analysis. Priya?
Right, sir. Okay, so one question is how we work out the foreign currency loan fluctuations in valuation and repayment of long term, like 20 years or more. And so, yeah, this is the question. As you just
Okay.
mentioned about the bullet train financed by Japan government.
Okay. So when we say the sensitivity analysis, I think it is one variable which comes out of this question is foreign currency exchange, and how do we perform a sensitivity analysis for I'll come up with the answer. Any other question besides this?
Yes, sir.
Okay.
1 second.
Because it's a part of sensitivity analysis. So that is what I think the point is, how do we account for these fluctuations? And my question is same. And one variable which we will be working around is the foreign exchange currency variations.
Okay, so one person has mentioned, his name is Hitesh, and he has written as unexpected situation like war of Ukraine make whole world suffer, one or otherwise. What kind of provisions and help in such conditions from the lenders?
Perfect. So this is a part of risk management. I think we are covering both the scenarios. You will find the answer before I sign off, because that is something which we'll cover. Any other question?
Why simultaneously financial model audit and consultants?
Okay. So basically, the financial model audit is not only done by the practicing chartered accountants. It is done by even some finance professionals from other domains. Even chartered accountants also do it, and non-CAs also do it. I agree to that point that the word of audit, we should only come up with professional accountants or chartered accountants. The problem here also is that this is an international terminology. So this is not, which India is yet to adopt it. So when institute comes out, some kind of advisory on such kind of audits, I think then we'll be only able to have financial consultant audits. Any other question, Priya?
Yes, sir. Okay, so basically, in this they have mentioned how funding from foreign can be arranged, and what type of products are available in the international markets for Indian corporate. Second, can a company whose past performance is not up to the mark due like default situations, can traditional banker consider proposal for new finance based on future scenario?
So I think when you look at international markets, right, it's a very wide question. But one thing I can tell you that these unrated projects which we were discussing, these enterprises, rather rather when we talk about the tech companies, when we talk about the infrastructural companies, when we talk about the telecommunication sectors, right? All these sectors, the Middle East is an area which is very active in providing a lot of support to all such projects. The kind of funding when you talk about it is naturally a debt funding also. Sometimes these fundings are done through the venture funds or the private equity companies in the form of convertible debentures, also in form of compulsory convertible debentures also. Also, they sometimes it is a hybrid model that certain portion of these projects are funded on equity basis and certain projects are done on debt. So all the sources are open. Why does an entrepreneur move out? I think there is a clear interest rate advantage, number one. Number two, as global banks, these banks like a Standard Chartered Bank in this particular scenario would always want to take its, will not want to keep all its eggs in one bucket, but will always want to keep it in different scenarios. And that is how equity funding market is also driven throughout the world. So no fund will come and start saying, a global fund that we aggressively only start investing in India because the future of India looks very vibrant. So that is also not happening. But all these models are available. Also, there's a lot of interest rate competitiveness. As I was telling you about the Middle East companies or the Japanese banks or the Southeast Asian companies bank. The arranging the source is difficult, but they have a standard mechanism, right, in approaching it. Eventually, as CAs, we have to do that kind of tie-up wherein you have in your bankers list, in your potential bankers list, when you reach out a client, you should already make a tie-up with these international banks. They have both process. One, you can do a tie-up with somebody who is in Middle East into project advisory and start this. The other is they come up with empanelments and you can take those empanelments. There's a tedious process. So as SME practitioners, it becomes very difficult to qualify for those criteria. So my suggestion is that to begin with, you can have that kind of a tie-up. Also, you can approach these organizations. You can find out schemes, like in this case, Adani find out a scheme of green hybrid loan, which was, as I told you, it was the first loan, and that is why they need a financial model audit consultant also, and they needed a independent assurance agency to provide assurance on this project. So all these things. The second question was, if somebody's track record is not good, then what do he do? So naturally, with CIBIL coming up, with credit scores coming up, with all data being integrated in this country to the major extent, now it becomes very difficult that if you have defunct the loan, if you have defaulted a loan, rather even if you have defaulted, forget default, even if you have skipped your principal interest payments, then also everything is recorded as a part of your CIBIL score. So point here which I would want to make here is that in such a case, the conventional bankers will be very conservative, and I don't see too many potential of cracking it unless you have to change few things, get new promoters or get some collaborators. The other option is sometimes you have to also give more security, be it the primary security or be it the collateral security. You have to then assure the banker. Bankers will be conservative in such a scenario. The only thing which I think gives them a comfort is a good good backup or good investing partner into it, or a good strategic partner, or more and more of collaterals which can make them feel secure. So once you restart that banking, you come under the category of good borrower. Then again, your past is deleted. So that's the beauty of this entire score also. So that's my point. Priya, did we receive any question? Oh, any answers?
Yes, sir.
Okay.
So
The
basically,
financial model.
yes.
Right.
For financial model, one person has answered, Aditya Mathur. He said variables like price, cost, changes in the government policies, etc. And the second answer received from Kiran Kumar Ved, cost escalation and ROI changes.
I think fair enough. We have got some answers. Happy to receive these answers. I'll straight away go if we have to do a sensitivity analysis. So let's talk about the variables. And when you do this sensitivity, you have to talk about, eventually you have to talk about the impact on NPV, the net present value of the project, or the IRR. So take a variable and do this variation, right? So one is sensitivity to project timeline. So if a project timeline varies by plus minus 6 months, then what will be its impact on cost? This sensitivity you need to certify. What will be its impact on revenue? And since the project timeline is varying, then what will be its impact on the financing requirements itself? So when you look at it, the first thing, if start doing a sensitivity analysis, variate the timeline of the project. This can be plus minus 6 months. This can be, certain people do it, it depends on the entire duration of the project. So it is not only one case scenario. But in Adani Green, they gave a scenario of plus minus 6 months, because the only catch in a renewable project is the acquisition of land. The rest things can be fast tracked, irrespective, be it wind or be it installation of the solar panels. The second is sensitivity to the sales volume. And when we talk about sensitivity to sales volume, then if your projected sale varies, say, from plus minus 10% or plus minus 5%, whatever appropriate variation do you see? In this case, while a greenfield project is installed, majority of Adani Green entered into a power purchase agreement with state government, as well as they aligned themselves with Jawaharlal Nehru Solar Mission also for generating power and trading REC certificates there. So I would say not more variation here. You can see not more than plus minus 10% variation here. And eventually then you have to show what is its effect on the revenue, what is its effect on the gross profit, the profitability ratios. So you need to adjust those figures. The third is the question which was coming out, how do we do sensitivity analysis? And I would say, if you have seen Ind AS 107, so Ind AS 107 also provides about a sensitivity analysis which a company needs to do for a foreign exchange risk. It's a very similar scenario. You can refer that. You can refer that table. You will find it in any listed company. That when a rate changes, when the rate of the foreign currency changes, then what is its effect on the revenue, expense, and eventually the cash flow. So with every rate change, you have to show its net impact on the revenue, expense, and eventual impact on your net present value at internal rate of return. I hope I am able to answer your question. Then, so these are, 2-3 sensitivity analysis which you can do, but you can obviously do sensitivity analysis on other variables also, not only project timeline. You can do a sensitivity analysis on your interest rate. You can do a sensitivity analysis where if your interest rate from the lender varies, then what is its effect on your the after tax margins and before tax margins. Similarly, you can do sensitivity analysis on the tax rates also. So if tax rates varies, if corporate tax rates tomorrow in next fiscal year you expect it to change, then uh, what kind of impact, eventual impact will it have on the NPV and the IRR? So all these things are part of sensitivity analysis, and this is what a modern, chartered accountant is expected to do when he is advising these large concerns on the transaction. The other part where, while we were discussing was in financial model audit was the risk assessment. Now, my next question is, how do you carry a risk assessment? What all factors do you carry a risk assessment? Any answers? Priya, again, I have to bother you.
So I'm just waiting for the answers to come.
Any questions in meantime?
Definitely, sir. One of the member has asked any likely provisions of code of ethics in the area of project financing, which needs to be kept in mind while adhering by the chartered accountant.
Only one thing, and maximum cases pertain to only one thing, sir, which is if you are certifying any financial projections, right? That is where which is clearly prohibited. If a bank expects you to certify any financial projections, that is only thing which you should keep. The bankers expect. The real situation is that I know the bankers expect you to certify it, but I'll give you a practical answer to this. I think we have at least 5-7 cases, to my knowledge, in disciplinary directorate pertaining to where bankers have certified client has defaulted. So make sure that we don't become a party to it. Yes, we can do financial model audits, right? That is not certification of what we are getting. That is certification of the basic assumptions or the basic, calculations. But eventually, you also need to put disclaimers into such kind of audits also. That would be my request. Any answers, Priya, for how do we carry a risk assessment exercise?
Not yet, sir.
Okay. So I think I'll straight away take them to the answers itself. And these are those risks which we need to quantify. The first is the market risk. And this is in context of this project only. And I have extracted the report from, the reports only while giving this. So one is the market risk. So first you categorize when you do a risk management exercise, you categorize what all risk can be there. Somebody asked this question: if there's a war between, Ukraine and Russia, and it has some kind of impact, then how do you classify it? So you classify it as environmental risks, sir, and you classify it there where or if the project is aligned to it, you can also classify it as a regulatory risk. So the point here is that these risks are classified, and what all do we do in each risk? Let's try to dissect that fact. So first is the market risk, and if you have to do a risk management, then you have to talk about what all risk these projects have, how company is robust enough to mitigate this risk, what are its plans, and you have to design those plans for the company for each risk and its response. You have to rate this risk, you have to categorize this risk, and then eventually you have to certify this, that this risk is within the acceptable level and company has taken enough care to mitigate these risks. So the first one is the market risk. And when we talk about the market risk, then I am saying with Adani Green, maybe the fluctuation in electricity prices, or the demands or the connectivity of the grids and everything, right? For example, in Adani Green, you will see that Jawaharlal Nehru Solar Mission, one risk which was categorized was that the REC bonds, which which needs to be traded on IEX, right? Sometimes are not traded. Sometimes a generator has generated these bonds, but there is no buyer of these bonds. and that is when you are not able to realize the price of a particular unit generated. That's a typical market risk, I would say, in this scenario. The other is, market conditions and potential market saturation. If there is, since Rajasthan is a hub, a lot of projects coming up, but India is an electricity scarce nation still. So that kind of a risk was well mitigated, was a low category risk, right? What if there's a change in government policies? And this risk can be a regulatory risk also and can be a market risk. So you can classify it at both levels. Now, the other part is the technology advancement, right? And when we say technology advancement, then here all the technology which Adani Green is using, say if they are using the crystalline solar panels or they are using the thin film technology or they're using some, from where they are importing the panels, what kind of per unit electricity will be generated, what is the expected number of days for which, they will be able to generate a solar or a wind. So all these things with respect to technology. So tomorrow, if you say a solar panel's life is say 25 years or 30 years, and tomorrow you expect that the life of the solar panel might only be 15, 17, 18 years, then what kind of change it has on the project in case of technology degradation? Similarly, if there is a technology advancement or there are more competitive I would say solar panels being created, which like happened in last 10, 15 years, then you will realize that because of the technology, government has started procuring it from the vendors who are supplying the electricity at low cost. So with technological advancement, the risk response of Adani Green was that we have entered into PPA for 25 years. So even tomorrow the technology changes or something like that happen, we have an assurance of 25 years revenue. The next is operational risk, and operational risk, as I told you, that it could be equipment failure risk, it could be inefficient project management, it would be environmental, it would be inefficient project management or supply chain disruptions. All these are classified in operational risk. The next is the financial risk, and as the name suggests, there we have a vital role to play, right? What if the cost overruns? What is its impact? Right, the currency exchange fluctuations we discussed, the interest rate fluctuations we discussed, and sometimes while you do a financial model audit and you certify the risk management, then what kind of risk this entire project has if they are not able to source continuity in funds. So all these things are also required to be taken care of. Then you have the regulatory and the policy risk. Adani, while I can tell you, there was an event in West Rajasthan, and before that it was Resurgent Rajasthan. All these events, these bigger companies come up with hefty amounts of commitment to the state and grab lot of incentives and benefits. The logic of doing this is, they coming up there with large number of investments and generating employment. So there are state government plus central government schemes which provide subsidies and everything. And certain projects are so much dependent on subsidies. Like if you recall, while initially we were setting up wind projects, we had our ATIA exemption talking about giving benefits to wind projects, and a lot of people to claim that accelerated depreciation installed wind projects. Eventually, the projects did not, because they were the smaller size projects, did not have viability, had to fail. So what if these incentives are not there, then what kind of risk this project has? ऐसा तो नहीं है कि सिर्फ project इसलिए लगा है कि incentive लेना है. So that factor needs to be dissected, right? Sometimes the approvals and everything from the state government, from the central governments, what kind of impact it will have, how important is, see, these are the risks. Important is how this organization responded to it. So when you give an assurance on that, I think there's a lot of comfort these international lenders have, right? Then you have the technical risk, environmental risk, stakeholder risk, right? So all these risks are part of risk management. Another important term was there, right? Priya, I'll share this presentation. If you want, you can share it with the participants also,
Sure, sir.
because we are running short of time. I'll just take one thing where we were, discussing this entire project. And then there was one more term coming up, independent assurance provider. I see a lot of potential in it. So while you are sourcing any international funding, uh, now the independent auditor's report holds less value in comparison to independent assurance which is provided on a project. In this case, KPMG was their partner to provide independent assurance on all 4 SPVs which they form. While you do independent assurance, while you are an independent assurance provider, you have to certify the financials as well as non-financials of the project. When I say non-financials, I am talking about its impact on environment, its impact on society, relating it to the sustainability goals, because it's a greenfield project. So once KPMG certifies it that it is a green hybrid loan, then only the consortium of banks will come and uh, will offer you fund. Similarly, this could be done by any provider. Again, I would say, important is how many empanelments you are able to secure from these international agencies, because eventually then they will come to you and ask you for that kind of certification. But here you have to certify the financials also. So if there's a historic data available, you will certify the financials, the non-financials also. You have to prepare a report. You have to certify it is a greenfield project, and eventually, when you certify this acts as an assurance to your lenders to do that. So this is where I see the unconventional roles coming up. Before I conclude the session, all I can say, I think the times have, I started with that project financing is into last legs, but I feel this is an immense potential. I genuinely feel one thing, that as professionals, that kind of an upgradation which the bigger companies have taken, it is high time that we also take it. Not only from the point of view of larger projects like Adani or something. I am telling you, next 5, 7, 8 years, while the all private equities are exhausted with their equity funds in the country and are invested in the startups, you will see a lot of startups looking for debt solutions. So look for it. You will see a lot of startups, lot of MSMEs coming up. They were always a part to it, but since they don't have official supports or they don't have official access to the banking arrangements, you can play a vital role there. For the larger projects, yes, there has to be capacity which we need to build, but make sure that we are updated to the things. And you will see every time a transaction is happening in this country, at least 4 or 5 new roles are evolved for us. So try following those rules. Look at your interest, and align your practice into these new domains. With this, I would want to again place my thanks to PDC, the co-speaker Pradeep sir, who wonderfully deliberated.
Namaskar.
And
I will add a point to your Ankit ji. Well done, fantastic. May I add one point there? What is the risk you were talking?
Right,
the war and disturbance you were talking about. There is another category, like I've read many books on this, on the risk factors. We tell it is political risks, can be a category.
Correct.
So there is the change of the law in the country affects the project. Sometimes there is expropriation. The government takes over the private property, so the project gets hampered. So many political things happening in the country or the abroad, like see Pakistan in civil disturbance today. So a project of yours can differ. Possibly political risks also there. So a lot of these things which come, we can have a separate classification of political risk sometimes, because I have found authors who have classified this separately.
Perfectly said, sir. Perfectly
said. Instead of putting environment or somewhere else, we can put it political risk.
Political risk.
Just for
I agree to.
I
academic
agree to it. Also, we are just learners. Ankit bhai, hum bhi learner here. But we
सर
learned that we
स्पीक
are also learning till now.
स्पीकर और
हाँ,
ऑडियंस में एक ही फर्क होता है कि स्पीकर को उस दिन पढ़ के आना पड़ता है,
नहीं
बाकी
हम
तो सब
सुन
आई
रहे हैं,
थिंक
सीख रहे हैं। अरे जिंदगी भर सीखना है, बट whatever we learned we should deliberate. हम लोग तो गुजर जाएंगे कभी ना कभी, तो we should deliberate upon so people can hear from us. That is the main motto. That's why we are here for the institute.
परफेक्ट.
Thank you, madam. Thank you. Any other questions?
मैम? Ma'am, your voice is not audible.
No, voice नहीं आ रही मैडम.
So we have 2-3 questions more, but I think we'll conclude. Maybe we'll give you separately and you could answer that. Or
No, no
right
problem.
now.
Sure.
हम
No,
मेल
no,
में भी कर सकते हैं मैडम.
आप मेल कर दीजिए, we will mail them back.
Right.
Any of
Sir.
us. Please.
Okay, sir. And thank you so much. So on behalf of the Professional Development Committee, I'd like to thank both our learned resource persons, Pradeep sir and Ankit sir. It was a very, very fruitful, technical deliberations, and it was a lot of learning for all of us. And all our questions were really nicely answered. And so thank you so much for sparing your time. So we've started a series of webinars, and this was our first on project financing. So we'll have more of these kinds of webinars. And thank you so much, sir. On behalf of our chairman, Prasanna Kumar, sir, and our vice chairman, Mangesh Kinera, sir, and all the members of the PT committee, we would like to express a deep sense of gratitude, sir, for sparing your valuable time and joining us for today's webinar, sir. Thank you so much, sir.
Thank you, ma'am. Thank you.
Thank you,
All
madam.
the best
Thank
for your upcoming
Thank you.
sessions.
Thank you
Thank
so
you, madam.
much.
And
Thank
I've shared my email ID in case for the participants also in the
Right.
chat box. Okay.
Right.
So in
Sure,
case there
sir.
is queries, they can directly read.
Sure, sir.
Thank you. Thank you. We are pleased to have this done. Thank you.
Thank you, sir.
Thank you, madam.
Thank you.